Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Okay, to the economic data of the day, you're looking at PPI. If you back out food and you back out energy on a month-on-month basis, came in up 0.2%. But if you keep it all in there, you take a look at PPI final demand up 0.4%, and you have to wonder kind of what's going on. And how's the right way to take this on a year-on-year basis? Final demand was up by about 3%. So Mike McKee, Bloomberg International Economics and Policy Correspondent, joins us. Literally no one better, and I know that because he's my BFF and emails me things all the time, like price of eggs, Alix, that really contributed to the PPI.
80% of the headline PPI was due to goods prices going up, and the majority of that was egg prices, up 56% in the month. It's avian flu, and it has happened.
Because Paul's like, why can't we make more chickens? Which, you know.
Well, we do, but then we kill them all because they get avian flu. That was the major contributor, and that's the biggest reason that the core is so much less. The important thing for the Fed is that the categories that they take from PPI and put into the calculations for PCE all were much lower, like airfares, insurance, things like that. So the outlook is much better than it looks on the headline basis.
So net December 18th, we're still expecting, I guess, a 25 basis point cut?
We haven't seen any reason why we wouldn't at this point. A couple of Fed officials have said they would be ready to pause soon, but they haven't said when that is. So given that most of them have suggested they're still on track to cut rates, that's the bet.
But here's my question. I feel like this is a day two story of the CPI that we got yesterday. Is that, I mean, inflation isn't conquered. Like, it's not. So why the still impetus to cut in a more aggressive way?
Well, I don't know that it's any more aggressive. It's what they had laid out, and it's 25 basis points. They're not going back to 50.
But why even cut it all when we know that inflation isn't
Well, that's
licked?
what the pause folks are saying, is that we still need to make sure that inflation's going down. And the answer to that from the other side is that inflation is going down, and it would continue to go down given even a lower interest rate. And one of the things they can point to from the CPI is that owner's equivalent rent, the crazy way the government calculates housing costs, went down to just a 0.2 rise, which is the lowest since January of 2021. So they have been waiting for housing prices to roll over, and it may be that they're finally doing that. And if that's the case, when you back out housing from the CPI, you're pretty much at 2%. So the odds are they can. They're going to look at that and say we can cut some more. Not as much maybe as we thought we would. Neutral, maybe higher, but we can cut some more.
We also had jobless claims that came out today. I guess the highest in a couple of months. But I don't know. As long as I still see like a 220, 230, 240, I don't know. What did you take away?
You're in a range. The thing to remember about jobless claims this week is Thanksgiving was the prior week, and everybody took 2 days off, so nobody went and filed jobless claims during that Thursday and Friday, and so they all go last week when the offices reopen and we get this bump.
I hadn't thought of that. Did they teach you that in like economics school?
Yeah, there's a whole class in holidays. No.
How does that work?
Holiday seasonal adjustment. It is an issue.
Called experience.
Especially this time of year, because the holidays float. They're at different times every year, and this was a very late Thanksgiving, which impacts retail sales.
Shorter holiday season.
That.
Yep, we heard that.
Okay, so what are you looking at next? So we're going to get the Fed on Wednesday, but then what? I mean, like, what's going to be that market-moving moment?
Well, we're going to want to see what happens with retail sales next week, which is the same day as the first day of the Fed meeting. Retail sales are expected to have risen. People still hanging in there, still spending money. And if that's the case, then that puts us in line for continued stronger than expected growth, which should be, in theory, inflationary, but raises the question of productivity. Is that rising and absorbing some of this? So a lot to look forward to in the numbers ahead. But after the Fed, I think everybody looks forward to Christmas.
Yes.
And Hanukkah. And we will get PCE at the end of the month, but we will beyond that not get anything that's going to move markets.
That's basically like we're not really going to do much until the new year. Fair enough.
Who's working that week between Christmas and New Year?
You are, Paul.
I am.
You are. He
Boom.
does it because he takes every Friday off in the summer. So
that's true.
Just saying.
Yes.
There's an idea.
Well,
yes.
Yeah. I mean, hey, it works at some point. All right. Thanks so much, Mike McKee, Bloomberg International Economics and Policy Correspondent, joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Our good friends over in Europe cutting rates yet again, the third straight meeting cutting rates. And it doesn't feel like they're cutting rates from any kind of particular position of strength. There's just some concern about economic struggles across much of Europe requiring lower rate. Let's break it down with Huw Worthington, European rate strategist for Bloomberg Intelligence. He joins us from London via Zoom. Huw, again, the third straight time the ECB cutting rates here. What's your take?
Yeah, well, the markets had quite an interesting reaction to it, actually, because I think initially it looked at the headlines that came out of the ECB. As you say, we fully expected the 25 basis point rate cut, but there's a bit of change in language as well, basically saying that rates didn't need to stay restrictive going forward, which I think initially was taken to be sort of like a very dovish indication. And actually, markets have actually now moved to price a 50 basis point cut at their 30th of January meeting, which is a little bit higher than they had previously, basically being driven by worries about activity data. But right at the end of the meeting, Christine Lagarde did actually sort of put a little bit of spanner in the works and say that suddenly they weren't so confident about the outlook for inflation, and maybe the markets were probably, or people were expecting her to be more saying that there are downside risks to inflation, and that seems to have put the cat amongst the pigeons and basically set the front end bond deals, or bond deals generally in Europe, trading higher again. So they've actually moved in about a 10 basis point range around the ECB meeting. So there's a little bit of mixed messaging going on.
So it was really that last sentence, and let's go through that one more time. So Christine Lagarde said that they weren't as confident in the decline for inflation, that she was worried about upside risk. Is that what I'm reading? It just seems like in Italy, a 10 basis point jump to the upside in the 10-year feels a little extreme on that.
Yeah, I think that also that move might have been a little bit something to do with as well that people are concerned about this idea of PEPP, pandemic QE redemptions not happening from really, actually, basically, she said next week onwards, and that pressuring the spreads. That may be an element there, but yes, she said that she basically, I think the idea that a lot of the economist community is they look at the numbers for inflation going forward, and they look like they're as flat as a pancake in Europe. But then she said that, I think everybody's assuming that basically the risks look really biased towards the downside. And she basically refused to, or didn't go along with that track of thinking, if you like. And that came in right at the end of the meeting, and that seems to have just literally, it certainly it made the currency jump, and it made the yields jump. And what I think we've seen is a little bit, whilst we are expecting a 50 basis point cut in January, what markets may be starting to do is just possibly looking for a little bit of a pause or less aggressive cutting cycle thereafter that 50 basis point cut, and that may be what the people have taken away. We'll see if they sort of try and lean against that as we get sort of reaction, which tends to happen with ECB meetings. But when they look at market reaction, they may not like it. They tend to sort of try and lean against it in subsequent comments. So let's just keep an eye on that going forward.
So Christine Lagarde, president of the ECB, calling out weaker than expected economic growth, or just I guess maybe persistently weaker than expected growth here. What's kind of the economic backdrop that's got the ECB concerned about growth?
Well, I think we had a it's actually, people are expecting growth in Europe to be pretty poor for quite a long time, and it's actually held up pretty well. We've certainly had the Olympics in France in the summer may have helped things a little bit, but more latterly, I think there's just the higher interest rates and the situation, obviously, in terms of the energy costs in Europe and the Russian-Ukraine war and everything else has just weighed on things. And frankly, the growth outlook has it's going to be okay in 2024. But it's basically that a lot of the PMI surveys and the survey data generally is pointing to, at best, sclerotic growth, and in reality, probably, a little bit possibly risk of contraction again. I think looking at 2025 GDP growth in the latest forecast was 1.1%. That was 1.3% from September time, and frankly, they'll probably be very lucky to be hitting that 1.1% sort of target.
Yeah, which really begs the question also, when do they actually start cutting because growth is weak and they need to support the economy versus inflation has come down, therefore they can remove that restriction. All right, great stuff. Thank you for explaining that to me, because I was so confused all throughout the presser and the statement and then looking at what happened to Italy. So I appreciate you, Huw Worthington, Bloomberg Intelligence European rates strategist. But it is interesting, you can't argue with the global cutting cycle. Yep. I think we're now just in how deep does that global cutting cycle go and where, and does that actually, should that inform where you put your money?
All right, and 6 days from today, we'll have the U.S. Federal Reserve, and the expectation is for a 25 basis point cut.
Look at you with like the day math.
I got my there. I got my calendar up there and everything. Calendar. I'm on top of it. Fed Go is everything you need to know about the Federal Reserve.
All right.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So head over there. Ann Berry joins us in studio. She's a founder and managing partner of Threadneedle. She invests money for a living. I wrote in our chat, the surveillance chat this morning, I just dropped a note in there. I said, hey, there is a palpable sense of optimism in this country since the election. And I think we've seen it in financial markets. Did you guys change your outlook for investing, opportunities, risk, post-election here?
I actually didn't. Okay. And while I'm optimistic, I don't have the same euphoria that I think we're seeing translate into these market outlooks. And one of the reasons actually is pertinent to today, which is I think we're going to see interest rates that are higher for longer than we expected, not just because of the inflation data we saw today, but because the noise around the policies that we think are coming in next year don't lend themselves, in my opinion, to having a rate cut. And I think that changes the outlook for tech. I think it changes the outlook for some of these AI stories that have been getting the biggest pop over the last 18 months. So I don't have the same, embrace of these massive all-time highs that we're looking at for next year.
So the other point, though, is, and we just heard from President-elect Donald Trump, is that we're going to get tax cuts. Yeah. It feels like we're in a very animal spirit place right now. Yeah. I appreciate stocks are down today, but I think there was a SPAC yesterday, like Bitcoin at 100,000. Like this isn't like a 2018 feel in some respects. Does that offset? How does that meld with what you're saying?
Yeah, well, when SPACs are back and meme stocks are roaring again, then to your point, Alix, you're in this sort of place of, I think we're in a bubble in some respects. Look, I think at a minimum, I think we're going to see the tax cut extensions, right? We know that that's a certainty. I think there's a question out as to whether we really see corporate tax rates coming down to 15%. We'll see what the offsets are with tariffs. But I do think where we still have uncertainty, right? We don't know what's going to happen to big sectors like pharmaceuticals, right, when there's a change in healthcare policy. We don't really know yet what the impact of DOGE is going to be, if we're going to see margins getting squeezed in some big sectors like industrials or defense. So there is this optimism, but I do think that we have yet to understand what specific policies we're going to see from incoming President Trump. And until we do, I think it's difficult to make a real bet.
Where do you see opportunity just in the markets in general? Are there any sectors that are screening well for you guys these days?
Yeah, there's some areas of consumer discretionary that I'm getting more excited about. So there's been a period of real noise around the state of the consumer over the last 6 months. We're getting more data that says it's sort of stabilizing to perhaps getting a little bit better as inflationary pressure abates for the parts of the population that's been hardest hit. Experiential is a place, Alix, I've talked about this with you in the past, that I've always been excited about. And I think elements of travel, the cruise industry is one that was really
those stocks have done really well.
Really well. And this is one I actually bought, Carnival Cruises is one I bought in the depths of 2020. I bought airlines at the same time. Airlines I hung on to, Carnival I sold out of too early. And the reason was there was a period of time the recovery was much slower than it was for other parts of travel. People didn't want to be cooped up on these ships. There was still that overhang of COVID. And the leverage of these businesses, these ships, when you go buy a ship, you take out massive amounts of debt to finance them. And so I got spooked by the leverage levels. I now have conviction that the free cash flow profile, the margin profile, the ability to take price of this business is back where it should be. The deleveraging is happening. So that's why I've been going back into these kinds of names.
What area, sorry.
No, go ahead.
You mentioned worried about tech then in AI.
Yeah.
I mean, is that really a levered play to rates? People talk about it as it's like a structural change.
I think there are some cases where it is a levered play for rates. I think you've got some AI stories where the free cash flow profile, where the path to profitability remains not obvious. I think there are parts that are not levered plays to rates. For example, the big tech businesses that are already free cash flow generative, where they've gone through this 24-month cycle of cost cutting and they're aggressively reinvesting behind AI, that to me is not a levered play on rates. What that is, though, is setting up 2025 for a real year of show me the money. Right? Show me the productivity is coming through in your KPIs. Show me that your margin is truly being enhanced. Show me you're getting adoption and you're taking price, and this is not just becoming table stakes. That, I think, is going to be the big question mark for 2025, is execution turning into dollars.
On the consumer, what's your view on the consumer? How do you think the consumer's doing out there? Because if you're going long a cruise company, I would think it's pretty constructive.
Well, I'll answer your question in two parts. When it comes to cruises specifically, the value proposition for consumers is great. You're getting a vacation at a 25 to 50% discount to the land-based equivalent. So
wait, say that again? On cruise ship, I'm getting a vacation at a discount to the land-based equivalent? To
the land-based equivalent. So if you were to go and fly...
It's a way of looking at that.
Yeah, if you go to go fly to a hotel, let's say in Florida or Vegas, or you fly to a villa, right, you've got the transportation as opposed to a lot of these places for cruises, you can drive to the ports of call. It's all-inclusive. And if you've got to think about it, travel in the US has been really impacted by the cost of labor, by the services inflation that we've seen. A lot of these cruise lines are staffing with international labor. They're going out to nations outside the US to hire their staff, so that we haven't seen the same wage inflation that you've seen for domestic travel. So that's why when you're a consumer that's perhaps been pressured over the last year or so, this is actually an interesting value proposition for you if you want to take a vacation. More broadly, though, to answer your question, I've been looking very closely at default rates on consumer credit cards, on auto loans, looking at BNPL take-up, what that means for consumer spending. We saw these default rates creep up over the last sort of 3 to 6 months. It looks like they're now stabilizing if you look at the last amounts of data. So it feels as though there's a little bit of a reprieve coming.
Does that consumer call extend into, say, retail? I mean, talk about stocks on a tear. I can't tell you the number of days that Walmart has been at a 52-week high.
Yes, I love Walmart. I loved Walmart for a long time. I think Walmart's a little bit special, and I think retail, we have to break it down into a couple of constituent parts. Walmart, let's look ahead to next year. Something like 2/3 of Walmart's portfolio, by the way, is US sourced. So if we're now looking at retail and looking ahead to the tariff impact, I think Walmart's particularly well positioned in terms of its scale, its ability to buy at lower cost, but also its geographic mix. You look at retail like Macy's, for example, and what happened yesterday. Department stores are still really, really struggling. You look at certain specialty retail names. I never saw this coming. Abercrombie and Fitch has been on this unbelievable tear. So you've had some brown turnarounds that have been very successful. You've got other retailers. Let's take the dollar stores, Dollar Generals. They're struggling, right? Their share prices are absolutely in the toilet. So I think, again, it comes back to what is the value proposition? How is the consumer being sliced and diced, and who's playing to their strengths most effectively?
One of my favorite deals back in the day, doing deals, was Live Nation, putting that thing together. You like that one, don't you?
I've liked that for a while.
How the regulators approved that, I have no idea.
Yeah, right?
Yeah.
Anyway.
Live Nation, look, I went into that. I lost money in a bit for a while. I'm up about 40%. But I hung on to it because I really had conviction. This almost is tied into the cruise discussion that As the world gets more digital, as more of our lives go online, the flip side of that coin is people are going to look for more opportunities for differentiated in-person experiences. And Live Nation, and specifically the concert piece, has been a big part of that thesis. I've invested privately in other events-based businesses, music festivals, smaller localized venues, and there's this huge demand for them. I don't think it's stopping yet. Antitrust is a question, the Ticketmaster piece is a question, but for now I'm
They already approved it.
Yeah. Well. Yeah. They all approve Googles and things, and and they're under fire for stuff as well.
You put the largest concert promoter together with the largest ticket agency.
I mean, what do you think was going to happen? What about, we talked about tech and AI, so where do you want to be positioned?
In that sector specifically, where I've been more enthusiastic has been around some of these platformization plays. That's such a lot of syllables.
Yeah, what does that
but
mean?
Some examples are, two specific examples. Palo Alto Networks, if we look in the cybersecurity space. So if you take a look at the way in which a lot of enterprises right now have put together their cybersecurity infrastructure, they've tended to stitch together lots of esoteric solutions. And if you're sitting in the IT department or the risk department of these enterprises, getting all of these systems to talk to each other, to integrate, to have a holistic solution is really difficult. The Palo Alto Networks of the world are turning up and saying, no, come to us as a one-stop shop. We'll provide all the solutions for you. That's platformization. It's the coming together of all the constituent solutions. PANW has been doing it very well. They've been executing. They're willing to take pricing hits. They are willing to sell at losses to get people to switch over to their platform. It's panning out. It's working. Salesforce has been another one of those. Again, there was a moment where it wasn't looking so bright, but they've actually been delivering on that platformization play. And the reason I like these, Alix, is twofold. I'm on boards, I spend a lot of time on companies that are doing the buying. I know that they're actively looking for these kinds of solutions as buyers, number one. Number two, when it comes to AI, I'm a big believer that the big are going to get bigger, that scale is going to be what ultimately wins in the collection of data, in the scrubbing of data, and the application of data. And so I think these platforms are going to be the big data gatherers and the big winners as we go forward.
Any part of tech that scares you at this point?
Yeah, there are some parts of tech that I feel more on the hardware side. I feel a bit nervous about, and I've done a little bit of a 180 on this because I do believe that there is going to be a reinvestment cycle, as a lot of hardware companies, and they're pitching it. The Lenovo's of the world are talking about it. The Apples of the world are talking about it, where AI is now being built into the actual underlying devices. I did make a play to try and go into an industrial hardware around this, an industrial tech, and I think it's just moving a lot more slowly than I would have hoped. So I'm watching that with a little bit more nervousness than I was before.
All right, Anne, great stuff. Really appreciate it. Anne Barry, founder, managing partner over at Threadneedle.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele and Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so check us out there. I'd say anytime I want to get the latest poop on China, there is no one I want to talk to more than Leland Miller. He's the CEO of the China Beige Book. They have extraordinary data on China, the economy of China that really no one else has, and it really gives them a unique insight to what's happening there in China. Leland joins us from Washington, D.C. via Zoom. Leland, I'd love to just start really 30,000 foot with you with China. Give us a sense of how the economy is in China today, really, from your data, and what can the government do to the extent it wants to improve things there?
Well, I think if you look back earlier this fall, we saw some of the worst data we'd seen in a long while. And I think that's one of the reasons that you saw these big stimulus announcements in September. And they did do something. I mean, they did spur a little bit of increased activity and a little bit of increased confidence. If you look at what happened in October, our data were much better. In November, the data were also much better than September. So you've seen a pickup in the economy. Some of that may be manufacturing exports being expedited ahead ahead of Trump tariffs. But you're seeing an economy that's better than it was. It's not great. It's not strong, but it's also not catastrophically weak. So that's the position we're in going into 2025. It's sort of ironic seeing all these headlines about, giant stimulus happening and, will they flood the economy? The economy doesn't need it right now. If it needs it in 2025, it's because something's happening in the tariff world.
Okay, so this is such a great point, because that's what I was going to say. So that signaling for more government stimulus and rate cuts, you think that is not at all true, and that it has to come from a tariff issue that will then provide stress?
Hey, look, this is the important point to take away from the second half of 2024. Even in September, when the economy is much worse than it is right now, it's bad. It can be weak. It doesn't mean it's catastrophically weak, and it doesn't mean that it needs big stimulus in order, for things not to fall apart. So what the government wants to do is do just enough to be able to keep the economy stable. It's not reaching for a higher ceiling. It's not trying to juice things. What it wants to do is get the economy stable so they can worry about other priorities, mostly national security priorities, building up a domestic chip ecosystem, working on supply chain resiliency. Working on vulnerability to U.S. sanctions, these types of things, certainly a lot of things with advanced technology. What it doesn't want to do is juice high levels of growth. So it's trying to figure out what the minimum amount needed in order to keep going, and to not have to worry about the economy. It's not a priority, but it also doesn't want it to be its downfall.
To what extent are they concerned, are the Chinese government and officials concerned about tariffs that President-elect Trump is talking about?
I think they are concerned. I think they should be concerned because, tariffs are coming in 2025. We'll see as the administration fills itself out and as the policy gets more sequenced out, what exactly we see on what timing. But I think they understand that there is a very high level chance that they're going to see increased pressure on their major growth driver right now, which is exports. In 2024, it's the timing of this is remarkable because 2024, China spent the entire year, including through Xi, including at the plenum, saying we are going to double down on our manufacturing and export model. We're going to talk about new quality productive forces. And even though we have the highest trade surplus ever and we have a record manufacturing goods surplus, we are going to still double down on exports in a whole government effort to just keep pushing them out to the world. This is causing friction everywhere. But with Trump coming in too, who's particularly sensitive to these issues, you're going to see a problem. So I think that they should be very worried about the tariffs that are on the way.
What do you think, where in China, in terms of sectors, are still the weakest, and what can really be done for that?
Well, I think you need to put property off to the side because property is weak in large part because they want it to be weak. They have spent the last 4+ years, diminishing property as a growth driver, popping the property bubble, trying to keep prices down, trying to extend as little credit as possible into the sector. So property is weak, but it's sort of separate because that's part of the game plan. What continues to be weak and too weak for China's future growth is consumption. So if you look at retail, you look at services, you look at these areas of the economy that should be soaring. If the leadership was really paying attention to this consumption as a priority mantra, those are not doing too well. They're doing a little bit better than they were earlier in the fall, but they're not doing well. So everyone keeps thinking that there's going to be this giant fiscal blast and consumption is going to flip like this. In order for there to be a major restructuring of the Chinese economy, you do have to incentivize greater consumption, and you can't do that through one-off vouchers.
Leland, if I were to chat with some folks on the street, whether it's in urban centers like Beijing or Shanghai or out in the countryside, what would they tell me? Are they concerned about this economy? Are they happy with the economy? Where are we?
I think they're concerned. If they're traders, then they're trying to listen very closely to hear every time there's a stimulus announcement, then they're running their computers and buying because this is about short-term asset market trading. Most of these things are complete nonsense, and they're being basically broadcast by the street, by others, because they're trading opportunities. They're not macro changes to the landscape. So I think most of the people who are on the ground trying to live their lives are very disappointed in what they see. Yes, there's more policy support that's come in 2024. Yes, there will be more on the way in 2025. But is this going to fix what ails China? China has extraordinarily low domestic demand, and they're over-reliant on an export model that's about to be hit hard with tariffs. So with that combination, I would be very concerned if I were a Chinese household just trying to figure out what's next for me.
So based on that, What do you think is going to happen with tariffs? Like, we were all talking about how President-elect Trump invited President Xi to his inauguration. Like, do you really think that tariffs are going to be in the cards in a material way, or is this still the bargaining chip playbook?
Yes, I think tariffs are going to be coming in a material way. It's funny because, the street commentary, and I get these things flooding my inboxes every day. They like to pick up on some sort of personnel, something or other, some sort of anecdote, and then that is their reason why they think all this is just going to be a total non-issue. Scott Bessent doesn't like tariffs, or Bob Lighthizer not in the administration, or she may come to the inauguration, and therefore this whole tariff thing was non-existent, and it's not real. I would spend a lot of time second guessing these things, because it's very important to understand that at a core precept of what the Trump administration is coming to do is reorder the domestic economy and reorder international economic relationships, and part of that is going to be with tariffs. We still to be seen. Who gets tariffed and how hard and on what sequencing. I think the administration is going to work on that and transition the administration as things come along. But the idea that China is not going to see tariffs in a big way in 2025, I think, is a very optimistic take by the street.
Really great stuff. Super appreciate it, Leland. Thank you very much, Leland Miller, CEO of the Beige Book.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.